Let us now look at some of the illustrative provisions in various treaties in respect of royalty. The first example we are going to see is a case where the royalty is taxable only in the country of residence. So if there is a US person who is providing services to an Indian company, right, and he is a tax resident of US, in such cases the royalty will be taxable only in US. Now please note that this clause is not the clause of the India-US treaty when I mention US here or in any other slide. I'm just making a reference. So when an Indian company makes a payment to US, it is taxable only in the country of residence. So royalties arising in a contracting state and beneficially owned by a resident of the other contracting state shall be taxable only in that other state. Now seems quite simple, but then there are certain complications around it or certain points that one should know. How do you interpret this? Let us first understand that. So whenever you are looking at such a statement, first thing is it says royalties. Now what is the significance of this first word royalties? The significance of this word is that unless and until the payment under consideration qualifies as a meaning or within the meaning of royalty, it is not covered here. Now what is the meaning of royalty? Royalty could be defined under the Act as well as under the treaty. But since this clause you will find under the treaty, if there is a definition of royalty under the treaty, that is something which is to be referred to. So first point is the payment under consideration should qualify as a royalty. Second, arising. What is the meaning of arising? Generally, in the clause relating to FTS, there is a provision which says when would the royalty be considered as arising in a contracting state, right? So if the royalty is paid by a company in India to a recipient of US, when would it be said that the royalty is arising in a contracting state or arising in India? That is given within the provision of that relevant treaty. If that is not given, then the general rules relating to accrual or arising would apply. One can also refer to the meaning given in section 916 or 917, depending on whether you are looking at royalty or FTS, to see when would the royalty or FTS be deemed to be accruing or arising in India. So what is condition number one? Condition number one is that the payment under consideration should be royalty. Second, it should be arising in a contracting state. Which is the contracting state which we are referring to over here? It is India. And not only should the payment be royalty, not only should it be arising in India, the third condition is beneficially owned. Which means what? In this example, if the Indian company were to make a payment to US, right? But US is not the beneficial owner. And we will look at what is the meaning of beneficial owner. But there is a person in UK who is the beneficial owner of this royalty. Which means what? Suppose the Indian company makes the payment to US for the use of a brand, but the brand is owned by UK and therefore US, the moment it receives $100, let's say from India, it passes on that $100 to UK. In that case, we cannot say that US is the beneficial owner, which means that India-US treaty may not apply in that case. So the royalties which arise in the contracting state should be beneficially owned by the recipient. Beneficially owned by a resident of the other contracting state. So when we are talking about this US person, he should be a resident of United States, of the other contracting state. This word other is important, right? And how do I identify whether or not he's a resident of a contracting state? For this, you will need to refer back to Article 4, typically Article 4, which deals with residence, right? So once these conditions are satisfied, there is a payment in the nature of royalty. It is arising in India and it is beneficially owned by a person who is a resident of United States. Then what? It shall be taxable. Shall means what? Compulsory, mandatory, right? Only in that other state. Now, which was this other contracting state? This was US, right? In this particular illustration. So then if this condition is satisfied, then this royalty shall be taxable only in US. Like I said once before as well, this US is only for illustrative purposes. This clause is not the clause relating to India-US treaty, but it was just meant to give you an example. So in this case, what happened was that the right to tax was given only to the country of residence, which was US, for example. And this happened because of the use of the word shall. Now there could be another situation as well, where both India and the other country has a right to tax. Let's read an example of a particular clause which might be there similar to this. Royalties. How do you identify royalty? You look at the definition of royalty in Article 12. Arising in a contracting state. Again, if within Article 12 it is given when royalty would arise, go by that. Else, look at the provision of the Act or the normal interpretation which is there. And paid to a resident of the other contracting state. Now there's a small bit of a difference here. I'll just come to this in a short while. But barring this word paid, it is same over here. Here it was written that it is beneficially owned by. Here it is written that it is paid to a resident of the other contracting state may be taxable. Now here you have the word may, here you have the word shall. So what's the difference between the two? This word by itself reserved the right to tax a particular royalty in US. But when it says it may be taxable in that other state, what it means is that the right to tax is with both US as well as India. Right? Now let's come to this word paid. What's the significance of this? If you recall under section 195, when an Indian company or a person makes a payment to a non-resident, they have to deduct at the time of credit or payment, whichever is earlier, right? So if credit precedes payment, the taxation, the withholding tax provision apply at the time of credit. Even otherwise, under the Income Tax Act, for a company and many forms of assessee, the taxation is triggered on the basis of mercantile system of accounting, right? But we know that the provision of Act or treaty, whichever are more beneficial to the non-resident, should apply. Which brings us to a very important point, not only from a taxation of royalty and FTS, but some other cases as well. Wherever the language used is the royalty arising in a contracting state and paid. What this does is, this actually restores the right to tax or the right to opt for taxation to a non-resident only when they receive royalty or FTS. If it is only accrued, not paid, then it should not be taxed in the hands of the non-resident.